Okay, everyone. Let's talk about future and option markets. Okay, and today is March 23rd, 2020. Okay, so let's talk about future contract. We have something called a forward. People get confused all the time. They are very similar if you think about it. So what is what is the future of forward contract? And we'll talk about it, and then what's the difference. So think about it. So we have something going on, right? COVID-19, which is coronavirus that has a really big impact on the financial market globally. So think about oil price. Oil price right now is like $23 a barrel, which is the lowest in 18 years, right? So what does that really mean when people say $23 a barrel? What does that really mean? Does that mean you pay $23, they give you a barrel? Yes, it's exactly what it means. But do they give it to you now? No, it's a future price. It's a contract. Think about President Trump, right? We have a national oil reserve, right? So let's say U.S. reserve, oil reserve. So let's say this is an entity, right? If they want to buy oil, what do? They enter a forward contract right now, okay, with maybe with Saudi Arabia or Russia, okay. What do? Is they say, this is March, right? Let's say 6 months later, which is September 23rd, right? 2020. Saudi Arabia will deliver, right? Deliver 1 barrel of oil for $23. What does that mean? That means U.S. oil reserve needs to prepare $23 6 months later, and then Saudi Arabia needs to prepare 1 barrel of oil. You guys see that? It's a contract. It's a legal contract. It's like you sign something. Right? You sign something, and then it's a legal contract. Why do they agree on the $23 price? Why it is not 30 or why it is not 40? Because that's a market price. That's what people think how much it worth is right now. Why can U.S. reserve oil get it for $23? Because everyone else can get it for $23 too. That's the market price. So you guys see that? So this is a forward contract, right? Why is it called a forward contract? Because it's in the future, 6 months later. Okay. Let me erase this before we go forward. Okay. It's arranging calling for future delivery of assets at agreed upon price. It has a history. It came from Japan a long time ago. Originally they have rice because they realized something. Okay, because they realized that if you harvest, if it's a good year, right? If you harvest a lot of rice, the price will go down. If it's a bad year, you don't have a lot of rice, and then the price is going up. That's not good, right? That's not good for people who want rice. That's not good for people who are selling rice, unless you are a speculator. So that's why they originally have a forward contract in Japan a long time ago. I think before World War I. I don't know when exactly. They try to smooth the price of rice so that people know how much they're gonna pay for it, so that they can save money to pay for the rice. Those farmers can also know how much they can sell the rice for, so that they can plan to use the money in the future. So that makes making sense? It's like you have something jump, and then intentionally you use a future contract to smooth it. Uncertainty, right? You change an uncertainty into something predictable. That's what future contract or forward contract is used. even though title is future contract, we talk about the difference between those two is forward is between financial institutions, big companies, okay, or government, right? They don't have to. Future contracts are through exchange. You can buy a future contract. Actually, recently, the main reason why United States financial market is in trouble, one part of it, in my opinion, is S&P 500 future contracts or any stock index future contracts. They have a 5% down limit. So whenever the future decline more than 5%, it will stop trading. That creates some issue. Okay. It's kind of people are panic, and then you put a limit of 5% on it. That makes people more panic. Why don't you let it fall 15% in the night, and then people will recover? But that's not the case. So there are a lot of future contracts, but future contract originally comes from commodity like rice, right? Crop, or like metal, oil. The other feature of future contract is marked to daily. You need to have a margin account to trade. It's like a collateral. For forward contract, it's private arrangement. They could have something as a collateral, cash, or some other equipment. Can be customized. But for future contract, the collateral is a lot of times securities or cash. Again, the price, $23, right, for oil is agreed upon price. So basically, when party A and B, or when let's say if you want to, right, you and I, you want to buy oil from me. Let's say I produce oil, rich from Saudi Arabia. We agree $23 is the price. Okay. You don't pay me any money when we enter the contract. I don't pay you any money when we enter the contract. This is the price we agreed. So you need to know that whenever a future contract is initiated, there's no exchange of money to any parties. Okay. Then we have a long position, right? Long position, whoever wants to purchase assets, we call it long or buy, right? Short position is the other, right? If you want to buy, someone has to sell, right? This is sell or short assets. Is that making sense? So let's say I want to buy, right? I long or I buy oil, $23 a barrel, right? Let's say 6 months later, because this is 18-year low. It's not 18 months low, 18-year low. Should you buy oil? I don't know. It declined almost 70% in 1 month. So what do you guys think? Let me know, right? Again, in finance, I'm telling you that, look, everyone losing money. Okay, everyone is losing money those days unless you short it. There are people shorting it, they make money, but not that many. Most people lose money. But you lose 20-30%, it's no big deal, right? Oil is down 70%. Yeah, if you are okay with that kind of risk, you can buy oil, right? You can make good amount of money if the price goes back, or you can leverage 2 times, 3 times leverage. I don't recommend it. I'm just telling you that oil is down. So let's say 6 months later, right? Because my future forward contract or future contract is 6 months. 6 months later, oil price kind of come back to $50. Right, that's a spot price or the market price. I can buy from you for $23. I made, right, 50 minus 23, so this is 50. This is my 23. Okay, I made a good amount of money. I made $27. Okay, out of it. Remember, I paid nothing for it. Okay, I paid nothing for it. That's the beautiful part. I made $27 out of nothing. Okay. I did not commit any money into the future contract. I just, for individuals, you need to have a margin account, okay? That's all you need. Just need to have some money on it, right? And then, so you guys see that? I didn't even put $23 to make $27. They probably have some requirements, okay? Probably have some requirements every day. They have everyday requirements. Every day you need to have some money. Anyway, you can make a good amount of money out of it. However, the other side is, let's say, oil. They have a war, okay? Let's say Russia and Saudi Arabia start a war, okay? Oil price dropped further to $10 a barrel, which is, you never see this before. Basically, one country is probably going to be defeated. That's why you see $10, or we have a worldwide war, water war. Then you lose how much? $13. Okay, you lose $13 per each barrel, and a lot of times we buy a good amount of them, probably 1,000 or 2,000 at a time. Okay, I don't trade oil, so I cannot give you exact number, but I'm showing you the risk. However, with $23, you think it will go down? I don't know. I think that it has more upside than downside, but I'm not gonna touch it. Okay, there are a lot of. So the more you know finance, the more you realize there are so many things that look so attractive, but that's just not good for me. Okay. So this is a long position, right? This is when you buy it. The short position is just the opposite. Okay. So that's the short position, right? We don't talk about call option now. We'll talk about it later. Okay. So basically, whoever sells you oil, they make money when oil price goes down, right? So they make $13 here if oil price continues to drop. However, they lose money if oil price goes up, because whatever the money you make are the money the short party loses. That's the zero-sum game. This is zero-sum game. So this is a game for many people, speculators. Okay. There are many people trading those 2 weeks because the volatility is so crazy. We have a 10% up and down like within 2 days, even for S&P 500. So which means all companies 10% up and down. There are a lot of speculative traders. Okay, but I try to be a trader. I don't think that fits my personality. So that's why I don't plan to do it. However, if you want, you can trade a future contract. Future contracts open 24 hours a day. Okay, you can trade it anytime. You can trade it now. I'm recording at 11:30 at night because I sort of have to take care of kids during the daytime because the daycares are closed. You can trade a futures 24 hours a day. And then you can leverage it. Okay. You can make a good amount of money within a day. You can lose everything within a day. I mean, you can choose whatever you want. I don't recommend it. I'm teaching this class to train you guys to be wealth managers. We need to think about what is the purpose of money and why are we doing it. We are totally okay using future. Let's say if you think the financial or stock market will continue to decline. Okay, we will continue to decline, right? You can short a future to hedge against some losses. That's fine. You can short some a little bit. I don't even recommend you. Let's say you have 80% in stocks right now, right? 20% in bonds, and then you just think the stock will continue to drop. You want to cut it to 50%. Then you can short 30% of your position using future. Okay. You can short 30%. This is a really easy way to short or hedge against your current position without realizing any capital gains. Okay. So in long position, short position, long position will buy, short position will deliver, right? And a lot of times we don't. Forward is probably this way, and then futures through the clearinghouse or exchange. So exchange will guarantee that the transaction will happen because look, so if you long oil like for $23, right, and then all of a sudden it jumped to 100, you make a good amount of money, right? You made like $77, and then you buy 1 million barrels. So that's a lot of money. So whoever you are dealing with, they can declare bankruptcy because they cannot afford it, right? Because the money you make are going to be the money they lose. They can declare bankruptcy. Okay, so this money you make will be gone. So that's a risk you have, right? That's why we have a clearinghouse here. So they will guarantee that this transaction will happen. They will deliver it to you. They act as the people you are betting against. Okay, like essentially you are betting against this person, right? You are A, you are betting against B, right? But you don't know, right? If you lose, can you pay it? What if you don't have enough money to pay it? You can run to China, right? Or you can run to some other country and then hide over there for your life. And then this person B loses money or loses the money he could have made. That's not good, right? Vice versa. So that's why we have a clearing house. Charge some fees, and then whenever you bet with B, essentially you bet with the exchange or the clearing house, and then B will also bet with the clearing house. Let's see that they act as the counterparty for both of you. They take a little bit profit of the spread. Let's say they will give you, so let's say B want to bet $23, right? They will give you a quote of 23.50. You guys see that? So this 50 cents would be the price they would take to maintain their operation. So that's the whole idea of clearinghouse. The more you learn about risk management, the more you realize how important the clearinghouse is, especially when it comes to big financial institutions. And also we have something called swaps. Okay, let's talk about interest rate swap, right? So one party agrees to pay the other fixed rate of interest in exchange to paying a variable rate of interest. This is called a plain vanilla swap. Let's look at this example. Okay, company A, right? They have a 7% coupon, right? You guys get it? They have a 7% coupon. They have bonds, right? Let's say they issue some corporate bond. Okay, they pay a 7% coupon. Okay, they think interest rate, okay, will go down. Okay, company A thinks interest rate will go down, right? They want to pay a floating rate or variable, right? Whatever you call it, variable, floating means the interest rate changes every night. Okay, so how can they do it? They can choose to take the bond back, redeem the bond, or call the bond back, and then issue some other bond with a low interest. But they cannot do it every day, right? Because the bond issue requires underwriting, requires a lot of things. It's like a mortgage. It takes forever to get it done. So they can enter something called a swap. What they do is, look, they find a dealer, and then they agree that the dealer will pay company A 6.95% fixed rate in exchange for company A paying dealer LIBOR or London Interbank offer rate. Okay, so this is a variable rate. Why would the dealer do it? Because the dealer think interest rate will go up, right? When the interest rate go up, LIBOR will go up. Okay, let's say LIBOR right now is 3%, maybe later it's like 4 or like 8%, right? You never know. Interest rate is crazy those days, especially again today is March 23rd, 2020. Okay, it's a good time to remember. Because of the coronavirus, we have a crazy credit market. Within 2 weeks, interest rate can change like dramatically. Okay, so that's why this dealer is willing to enter this, because the dealer thinks interest rate will go up. Okay, is that making sense? Oh, let me just put it B here. Okay, let me just put B here, because another person B thinks the interest rate will go up. A thinks interest rate will go down. That's why they agree that they're gonna enter into something called a swap, interest rate swap, or plain vanilla swap. This is a fixed to variable swap, right? Swap means exchange, right? So company A originally, let me just erase those to elaborate a little bit again. Okay, let's just forget. Let's just forget about this part. Okay, let's just assume this is B. Another person, this is A, right? Company A. A was paying 7%, which is a fixed, right? And then through this, B is paying A 6.95. Let's just change this to 7%, right? What about this? plus 0.05%. B is paying A 7%. Okay, what does that mean? That means B pays A 7%, and then A uses 7% to pay 7% coupon, right? So this is fixed. The risk is eliminated, right? These two cancels out. A has no risk of paying 7%. However, A becomes paying a LIBOR plus 5 basis points. Okay, you guys see that? Originally A is paying 7%. Now they don't pay 7% anymore. They pay LIBOR plus 55 basis points, which is a variable rate. LIBOR, London Interbank Offer Rate, changes every night. Okay, every day it's different. Okay, you guys see that? Okay, so that's the whole idea. Okay, why we have a dealer? It's the same idea. Okay, because if you deal with B, B can default. They can disappear, right? Declare bankruptcy. What if the LIBOR comes back like 1%? Then look, you are paying 7%, right, to A, and then they pay you only 1%. You lose a lot of money. Company B lose a lot of money, right? Company B can disappear, or they can run away, or the owners can run away. That's why we have a dealer. This is also a clearing party, okay, clearing house. Is that making sense? A lot of times the clearing house, and sometimes they require some certain collateral. Okay, it's the same idea. And then there are a lot of other things, right? We have forward rate agreement, swap option on swap, and then we have OTC products, which is a really customized products within big financial institutions. So let's talk about options. Okay. What is option? This part is derivative. What is derivative? We have stock and bonds, right? Those are financial investment vehicles. Anything derived from stock and bonds and any financial vehicles are called derivative. It's derived from those. Okay. They have to depend on an underlying assets. That's what derivative means. So we have something called a call option that gives the right to buy assets at a specified exercise price on or before specified expiration date. Okay, what does that mean? Let's say American Airlines, I don't know how much it is, but it was $30 and then all of a sudden it dropped to like $14. Okay, let's just do American Airlines. Why it dropped to $14 within 2 weeks? Because there's no flights anymore. Okay, President Trump canceled all flights from Europe, Asia, and even domestically in the United States. Probably airline company get grounded, right, because of the virus. You never know how long it will take. People become so panicked because they have so many airplanes and so many people to take care of, and then all of a sudden nobody can take the flight. It's not their fault, right? It's a risk. Anyway, so you think it will go up, right? At least most people think it will go up because it won't go down anymore. It could go down. You never know, right? That's the beautiful part about finance. The more you know, the more you realize this thing is unpredictable. How can you know you're gonna lose 50% in 2 weeks in American Airlines? Maybe even more, right? So you want to buy American Airlines. Okay. However, you don't have enough money, right? Because it's $14. If you want to buy 100 shares, that's $1,400. You can use call option. Okay, you can use a call option. Okay, call option gives the right to buy something in the future. Let's say we want to buy AA at $15 a share, right? Before September, right? So always the third week before September 2020, which means the third week of September. So that's how option is written. So you have the right to buy American Airlines for $15 before September, third week of September. You need to pay, right? This is your right. Okay, you gotta get it. You need to pay for your right. How much you're gonna pay per share very likely very cheap. It's probably $1. Okay. In order to have this right, you probably pay $1 for this right. Is that making sense? So you don't have to spend $14 to buy this. To buy American Airlines, you spend $1 to buy this share at $15. You can have the same rate of almost the same rate of return as compared with if you buy one share of American Airlines. So what does that mean? That means 14 times leverage. You guys get it? 14 times leverage. Okay. So if American Airlines right goes up to $16, you make good amount of money. Okay. Let me just change this to 14. Okay. If let's say you have originally you have $14, right? That's all the money you have. Okay. And then you buy one share of AA, right? And then the price is 16, right? How much you make? You make $2 extra, right? That making sense? However, you don't want to buy American Airlines stock anymore. You want to buy the option. $1 each. You bought 14, right? You bought 14, okay? It gives you the right to buy American Airlines for $14 a share, okay? And then the price changed to 16 for each share you make 2. How many shares do you have? You have 14, so that will give you make $28 compared with $2. You guys see that? This is the leverage of options. So you make 100% return on this. Okay, you spend only $14 and then you made a 28. So you made an additional $14. Your return is 100%, just because the price goes up $2. Originally, your return is less than 20%. You guys see that? Okay, so let me. You guys see the strike price? How much you're gonna pay? This is $14 a share. That's a future strike price. Premium, you need to pay some money for the right. We paid $1 for this right. That's your premium, right? So that's what option is. And that's call option, okay? And then we have a put option. What is a put option? That's a right to sell assets at a specified exercise price on or before specified expiration date, okay? Remember, originally you have the right to buy, right? So that's a call option. The right to sell, it's a put option. Okay, so who's going to use put option if you think the stock price will drop? Let's say February 24th, right? This year, if you think Apple will drop, you can enter a put option. Okay, that will help you save a lot of money because the stock globally dropped 30%. So the put option will make a lot of money for you. Is that making sense? You have the right to sell. Okay, so let's say Apple stock was 300. Okay, and then you enter put option to sell, right? To sell for $300. Right now, the stock price probably around 230. You still have the right to set for $300. How much money you make? You made 70. Why you make money? Because stock price decline. Whoever buys put option thinks stock price will go down, right? Should you buy put option right now? If you think the stock price will continue to drop, you can buy put options right now. However, if stock price goes up, you are going to lose everything you paid for it. It's a right. You lose a right. Your right is not valuable. Okay. In the money means your option makes money for you. Out of money means your option is not valuable. You lose all the premium you pay. It's insurance. Okay. It's like car insurance. You had an accident. You get some money from an insurance company. You have no accident. You lose the premium you paid for it. Actually, the money means you get break even, okay? So let's look at one example, okay? So you paid $14, right? You paid, this is a call option, apparently. This is a call option. You paid $14 for this option, right? What is the strike price? It's $8 because you make money when the stock price, ST stands for stock price. In the future, right? So in you have the right to buy a stock for $80 a share in the future. If the stock price is $90, you make $10 profit. If the stock price is $100, you make $20 profit or payoff, right? Is that making sense? However, you pay the money for it, you paid $14 for it. Okay, that's why for the $20 you make, you paid the $14 already, so you only make, this is your true profit. You make only $6. This is your profit. So given that this is a recorded video, you can try to pause here and think about what I mean. Okay, let me just erase some handwriting. I'm trying to write with a pen. I've been using it. I think that's the best option I find. Certainly, if I could spend more money on a Microsoft Surface, that would be better. But I didn't. However, you just never know. Money is so. We have mental accounting. I taught about behavioral finance, right? We have mental accounting. You can lose a good amount of money in the stock market or make a good amount of money on the stock market, but you don't really treat that money as your daily spending money. However, like when it comes to daily spending, you still worry about $200, $300. That's mental accounting. Anyway, so the solid line is the payoff. Okay, the payoff line, it's always a good idea to start with the payoff. Okay, and then we worry about the premium. Okay, so the payoff says you are going to make money if this is strike price, right? This is strike price. Let me repeat it again. You have the right to buy a stock for $80 a share in the future. Okay, so that's what strike price means. In the future, when the stock price is $90, okay, your payoff, you have the right to buy it for 80, right? You paid 80 and then sold it, right? You make $10. Is that making sense? However, you have to pay for the right. Originally, you give someone $14 for this right already, and then you have $10 profit, right? You still lose $4. So like yesterday, right? Yesterday, you paid $14, right, on premium already. Like today, right? Today is $90. You decide to exercise your right. You bought it for $80 because that's your right, and then you sold it immediately for $90. You make $10. Okay. However, yesterday you paid $14 for this right. Okay. So the difference is 10 minus 14 that equals to -4. You still lose $4, right? So that's why many people don't buy call options, they sell call options. Okay, so it's the other way, right? So when you think the stock price, okay, will not increase too much, okay. If you think the market is high, or if you think the market will be stable, and you still want some extra cash, how can you do it? You can sell an option, right? As soon as the stock price is below 80, it's below $80, you are going to have $14 as your revenue, right? Because someone paid for that right. However, if a stock price goes up like crazy, you're gonna lose the opportunity because you get caught, right? The profit belongs to the buyer of the premium. So if you think stock price will decline or stable, you can sell a call, right? Call option is the same. If you go back to this, okay, this is a long position, right? This is when you buy a call option. This is a short position. This is when you sell a call option. If you look at this graph and then this graph, if you stack them together, okay, those two will be symmetric to each other. This is a zero-sum game. The money you make will be the money some other people lose. Okay, that's option. Okay, overall, all financial derivative is like that. Is that making sense? So again, this part is a little bit tricky, but if you just slow down, watch my video and pause, and you can search online, right, to see what a short position is, and then how to short a call position. This is very interesting. Some students trade it. I don't. I know how to trade it. I just don't touch it. Why? Because I have many other things that is important for me in my life other than trading. I prefer to spend time with my kids and put a purpose on the money. I don't worry about the number of the money. I need to. All of us should not worry about the number of the money, but you should care about what you want to do with the money. Okay. The life of a trader is not enjoyable for me, so that's why I don't do it. But I'm teaching you all of those in case you want to be a trader, or you can use it to help protect some risk in the future. This is a put option, right? You have the right to sell something for $80. Okay, you get it? You have the right to sell a stock for $80. If stock price drop to 60, you have the right. Let me just make it 40. It's kind of a middle point. You have the right to sell your stock for $80. What you're gonna do? You're gonna go to the market to buy a stock for 40, and then immediately sell it for 80. You made $40, right? However, again, this is a right. You pay the money. Let's say you paid a $10 premium for it. Okay. Even though you made $40, but remember you need to pay some more money to get that right. So overall, you make $30. That's what it is. However, look, it will protect you. When the stock crash, when the financial market crash, okay, a put option will protect. Put option is a protect crash. Okay, it will help you protect market volatility. So let's talk about this. This is really important for my classes. Okay, and you are going to see this in the final exam. I promise you. Okay. So I hope you guys are going to do well during this outbreak. You will pass, right? It's just a matter of time. We all know it. It is just hard and seems there's no end when you are in the middle of it. It's 12 o'clock at night, and because I have to spend more time with my kids because the daycare is closed. So I choose to record it at night. I hope you guys, and I know everyone is struggling with it. If you have limited access to internet, or if you, let's say many of you depends on part-time job, right, for some rent, some other basic like food or grocery, it might be a really tough time for you guys, but just hang in there, okay? Let me know if you need any help. Feel free to email me. You will pass, and we are all in this together, okay? Anyway, let's look at this 3 strategies. Strategy A, B, and C, okay? If you have money, you have $9,000, right? That's all the money you have. And then you invest 100 shares for $90 each. That's strategy 1. Or you invest in at the money position, which means you have the at the money means the strike price is 90. You have the right to buy something at the current price. Okay. Each one is selling for $10. You have $9,000. You can buy 900 cars. Okay, so that's strategy 2, right? 1, 2. Or you can buy 100 positions for $1,000. You have $8,000 left, right? You invest in 6 months Treasury bill at 2% interest rate. You guys get it? Again, this is a video, so if you want to take a pause, feel free to do so. We have 3 different strategies. We want to compare their return and risk. Okay. So let's look at this. Okay. Stock price, if it remains at $90, right? Your strategy A is 100 stocks. So $90, your stock, your current value would be $9,000, right? If it's $100, you have 100 shares, then it will be $10,000. That's how much money you have, right? If it's 110 times 100, you have $11,000, right? Is that making sense? And then the call option. Remember the call option, okay? So this is 90, right? This is $90, okay? And then remember, you will make money only when. So this is a payoff, okay? I always like to draw it because drawing it will make me it helps me a lot. Okay? So you pay $10, right, for it, and then it's $90. If it's $100, that's when you break even. If the stock price is $100, okay, you make $10, right? Because you paid $90 for it. And however, you paid another $10. This is when you are breaking even. Okay, is that making sense? So that's when you will make some money. It doesn't mean, but right here we are looking at the portfolio price. Okay, portfolio value. Okay, so if you have a 900 call options. Okay. And then if it's 85, right? If it's 85 here, you lose everything, right? You lose all the money you have. Is that making sense? Because you have $9,000, you buy all of them, okay? Using that. If it's $85, your option is worthless. It's worthless basically. You lose everything you have. It's 85. If it's 90, you also lose everything you have. However, when it is above 90, right? Let's look at 95, okay? Right here, it's 95, right? How much you make? You make $5, right? Your payoff, this is your payoff, okay? Your payoff is $5. How many options do you have? You have 900. That's why you have 4,500, right? However, you are still losing money, right? Originally, you have $9,000. Right now, you have only $4,500. You still lose money. That's why it's here. You lose, right? You lose money, right? However, if it's $100, you break even. Break even means you don't make any money. However, you don't lose any money, right? That's what it says. Or you can think like $100, right? Your strike price is 90. 100 minus 90, you make $10 on each option, right? How many do you have? You have 900, right? 900 times 10, that will give you 9,000, right? That's how we get the $9,000. It's the same. You can do it that way. And then let's look at the last one. The last one. Many students get confused about it. So you have $1,000, right, in options, and then you have 100 options, right? And then you have $8,000, right, in cash. Let's just say cash, and then you have 2%. 2% return. 2% times 8,000, that will equal to 160, right? So if you lose everything on option, how much money do you have? You have 8,000 plus 160, right? You have 8,160. That's how much money you have. Is that making sense? So that's how we get those numbers. You lose everything on the options, okay? However, when it is 95, remember we make $5 on each option. That's a payoff. You have 100, right? 100 positions. So that will give you $500, right? Again, this is cash. No matter what happens, you have cash. Okay, it does not change, right? So that's why plus 500, that will equal to 8660. That's how we get this number, right? For this number, it's the same, okay? You just change this to 10, right? 10 times 100, that will give you 1,000, right? And then just you just add 1,000 to this number, that will give you this. Continue to do this, you will get those. Again, this is a video, right? You can pause it. Let me just erase everything before we go forward. So the point is, look, if the stock price is 110, right, that kind of goes up like 20%. It's a good amount of return for a year, okay? So you have 11,000. However, if you go options, right, you have $18,000. You make more money here. You can see that. If things are doing well, you are making more money using options. However, with all options, you can lose everything, okay? If the stock price goes down, you can lose everything, okay? So let me just talk about COVID-19 or coronavirus again, right? The market hit like 30% globally, okay? Like if you look at small cap, it's going to be around 50%. It's even worse in the United States, right? Small cap. It's everywhere. The good thing about buying stock is no matter what, okay, no matter what, you still have some money left. You can see it? Even if it goes down like crazy, you still have some money. However, if you enter some speculative option strategy, you can lose everything you have. Even though you're going to make a lot of money if things are on your way, right? However, you are going to lose a lot of money. It's fair, right? If you want to get a high risk, then you are going to have high risk. That's what high risk means. You can make a lot of money or you can lose a lot of money. That's high risk. Okay? So let's talk about the third strategy, which is really interesting. Okay, maybe I think I would probably try to use this strategy sometime in the future. I just don't really have the mind or the mood of being a trader because I'm young, right? I need to try to improve my human capital. Yeah, but a lot of people I know, a lot of my friends are trading those things. Anyway, so you guys see this? Okay, yeah, if everything is good, right, you are going to make some money, right, but it's not going to be as good as those two. However, if things are going wrong, okay, you still have some protection on the downside. Okay. Oh, you'll say, oh, this is larger than this. What about 20? Okay, if the stock price dropped to 20, you have only $2,000, right? Stock price lose 80%. It's like oil. Assume oil price goes from 100 to 20, right? You have only $2,000 left, but here you still have 8,160. So that's the beautiful part, right? Combine a call with a treasury bill, you have a really good protection against downside risk. So that's what it looks like, okay? If you use Excel and then you try many different price scenario, you can see this is all stock. It's a straight line, call plus bears, right? You can see that this is flat, and then kind of the call option kicks in. These are all options. You either lose 100% or you make a good amount of money. It can continue to go up. Okay. Try to do this using Excel. I think I have the Excel template available. So let me to talk about option strategy. We talk about call option and put option, right? So taking my class, maybe you can take a rest here to give yourself some time to digest what we covered. Those are the basics. And then starting from here, we are going to tell you what are the trading strategies. I also uploaded an option trading strategy on Blackboard that is partially from CFA curriculum to show you guys in practice how we use options to fulfill some purpose of investments. So let's talk about protective put, right? So this is a really interesting strategy. Actually, Professor Carol Stead implemented this sometime late February after 10% decline. So after he saw a 10% decline in the stock market, he allowed some put options. I think it turned out to be good for his elderly clients. Assets combined with the put options that guarantee minimum proceeds equal to put exercise price. Basically, you have some put is a protection, right? Downside protection. You don't sell the stock, however, you bought some put. So when stock decline, right? You have some revenue from the put option that can offset the loss of stock value. There are many strategies using options to limit the risk of portfolio. And we have covered call position. What is a covered call position? Basically, so this is a covered call position, right? You make money when the stock price goes down, or if you think the stock price will be, how would I say? If you think the stock price will be stable, or it will drop a little bit, but you don't plan to sell the stock, you can write a call option on the stocks you have. That is what is called a covered call. It's writing a call on assets. So you have Apple, right? If you have Apple stock, you short a call on Apple plus long or on Apple stock. This is called a covered call. Why it's called a covered call? It's a call option, right? You sell a call option. That's where the call comes from. Why is it covered? Because you have Apple stock. Remember, a call option gives someone the right to buy a stock, right? If you have the stock, you can guarantee that you can sell a call on Apple stock. If someone wants to buy it, you have the stock available for them to buy from you. That's why it's called a covered call. It's not a naked call. If you have no stock, that's called a naked call. Okay. Then let's focus on straddle strategy. It's a combination of call and put, each with the same exercise price and expiration date. Spreader is a combination of 2 or more call options on the same asset with different exercise price and time to expiration. We have a COLA, which means you make your portfolio equal to 0 return in short time period. For this class, focus on those two. If you are interested, I will talk about COLA, but I probably not test it. So this is when you long a stock, right? You own a stock, and then this is when you long a put, right? A put will help you make money when stock decline. That's why I like options. Because I really like to draw things. Okay, if you think about how you can stack this part together with this part, it will become a flat line, right? So that's where the protection is. This is your protection. Right, you buy a stock, you buy Apple stock, and then you buy a put option on Apple. Your Apple stock will only drop to the strike price. After that, you will offset. That's why it becomes a flat line. Okay, because you can sell. Let's say right now the Apple stock is $300. Let's assume you can go back to the time travel. You see the stock price $300. It's good. And then today, right, it's 230, okay, $230, right? No, today, let's say today it's $200, and then you have an option, right? You bought a put option that you can set for, let's say, $280, right? Is that making sense? That's not making sense, okay. You have the right to sell Apple for $280. That's your put option. Is that making sense? So let's say today is $300. Okay, and then stock decline, right? Stock decline, you lose money, you feel bad, right? However, when the stock price decline to $280, you are protected from that point. You lose only like 6%, and then after that you get protected, because for every dollar you lose, your put option will make $1 for you. So those two will offset each other. Is that making sense? So that's why you see a flat line here. You will only lose up to 280. After the stock price decline to 280, you are good. You are solid. Okay. So that's what it means. Certainly you need to pay some money for it, right? So that's probably not that much if you bought it earlier, because nobody believes the market will decline. So that's a comparison profit on stock. If it declines, you lose money. However, if you have a put option combined with the stock, it's called a protective put. You get protected at a certain point. After that, you don't lose any money at all. This is a covered call option, right? You have one stock, you own it, right? You own a stock, and then you sell a call, you short a call position, okay? So what does that really mean? If the stock price goes up, okay, if the stock price goes up, you lose money, right? You lose money on your short call position. Even though you make money on the stock you own, however, the money you make is going to be lost because you short a call. That's why it comes flat. Okay. However, by selling a call option, you collect premium. Okay, is that making sense? You collect premium here. So they give you $2, okay, and then you make $2 immediately. What do you give them? You give them the upside potential. If the stock price goes up like crazy, okay, it has nothing to do with you anymore. You don't make any money, even though you own a stock, because you lose money on the short call position. However, if the stock price decline, okay, yeah, you still lose money. That's true. However, the $2 you collected from selling the call position will help you a little bit. People do it all the time. Okay, they do it all the time. Because $2 is not that much, but if you do it every year, or no, you do it every month, that's it accumulates, right? It's still a good amount of money. People do it for so long, since 2009. They get themselves into trouble in February of 2018, and then I think they are in trouble those days, or March of 2020, because the volatility is so crazy. Okay. Another way would be straddle position. What do you do? This is a call option, right? And then this is a put option, right? You guys see that? Again, it's like drawing a graph. You put those two together, okay? Payoff, profit. How do you make money? You make money if the stock price goes up like crazy, or if the stock decline like crazy. This is betting the volatility will be high. You are going to make a lot of money if you have this strategy established before March the 1st, 2020. Okay. If you have this strategy, you are going to make a great amount of money. Okay. Because the market moves like crazy, like it can go down 10%, and then tomorrow can go up 10%, and then go down again. So you make a lot of money this way, mainly from the downside recently. So that's a strategy. Okay, again, this is a video, right? I assume that you guys can replay it, or like watch it several times. This is a strategy you know something is gonna happen. Okay, if you know something is gonna happen, but you don't know whether it will be a good news or bad news, but you know it's gonna be a really significant change on the price, what can you do? Strategy. Okay, so that's what you combine a call and a put together. You long a call and long a put. Okay, this is a bullish spread. Okay, so we long a call, right, with x1, and then we short a call with x2. If you combine those two together, you are going to have this. So what is good about it? You make some money here. However, if the stock price goes up very high, you lose those payoff. Why would we do it? Why do we do it? Why do we choose a spread other than a call? Because a call strategy can cost you a lot of money. Okay, because you see that there's a lot of potential here, right? It can cost you a good amount of money. But right here, remember, when you sell a call, right? Whenever you sell a call, you receive money from some other people. So let's say you pay like $5 for this, okay? And then if you short this, right, they pay you $3, okay? So overall, in this strategy, you only pay $2 for it, okay? You still have a good amount of return, okay, between this range, because you believe the stock price will move up, not that much, right? This is too much, you think, unlikely to happen. So you based on your prediction, you think the stock price will move in this range. So this will give you a really cheap way of achieving what you want to do, okay, without paying extra for the things that you think is not going to happen, okay. Again, there's no smart people on investments, okay. All those smart people are bankrupted, okay. I cannot say this is much better strategy, okay. The only reason why people are paying $5 for this is because they think this is possible. If you think it's not possible, and you think you are smarter than others, you can use this strategy. Okay? Or you have or maybe you don't have $5 to do it. You only have $2. That's another way of doing it. Okay, it's just cheaper. and then you need to know you give up the upside potential for something cheaper. That's all I have for today, and I hope you guys will be doing all right through the pandemic. Again, I have been through China's SARS in 2003. I was in high school, and this time it feels really different. But you will pass, okay? It's not gonna be here forever. Even though you feel like it's hard, everything is so inconvenient. But you will forget about it very soon, and then when you look back, you see that it's not as bad as it seems, okay? I hope you all stay healthy, stay at home, don't go to places that shouldn't be, follow the recommendation of social distance, be responsible, and take care of the family and the elderly people around us. And I really wish that we can see each other face to face really soon. Let me know if you have any questions, okay?